Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending March 15, 2024. So looking at the markets this week after 4 days, negative for bonds, interest rates higher on the week. We've had some negative surprises on inflation this week in the US. So inflation was a bit hotter than expected. Yesterday on Thursday, we had a rise of 10 basis points on the day for the 10-year rate in both Canada and the US. You know, these markets tend to move together. So higher inflation in the US pushed Canadian rates higher as well. The stock market continues to do well, gains pretty much everywhere except on EFI on the week. Oil higher by 4% on the week. Canadian dollar, euro stronger versus weaker versus the USD rather, and the price of gold also was down 0.8% on the week. So the story on the week is really the economic data in the US. We had two things that fly in the face of the current thinking in the market. So we have upside surprises on inflation. So inflation this week, PPI and CPI in the US were hotter than expected, and also retail sales were let down. So two things that are sustaining this market move, or at least the market psychology right now, is that inflation is falling and that economic growth is strong. So, you know, the best of both worlds, strong growth, low inflation equals Goldilocks and equals rate cuts by the Fed starting this summer, and many rate cuts. Here you have two stories that fly in the face of that. On the left, you have the 3 months annualized growth in prices, so the current pace of, or the most recent pace of inflation. You have total CPI, core CPI, for both the recent pace about 4%, so it's hotter than what is desired, and super core, which is core inflation excluding shelter, so really like the kernel of inflation here. The Fed has been citing that many times over the last year. Well, it's reaccelerating to above 6%, so it's not good news here, and it does put into question the timing of rate cuts and how many rate cuts we will see. Retail sales on the left, I brought the control group here. It's a sub-component of the retail sale, but it's more tightly linked to what goes into GDP calculation. So you see that in January it was negative, February pretty much going nowhere. So we're seeing some signs, some early signs that maybe we have a slowdown in consumption in the US. Now, it's always a tall order to discount the US consumer, but still we're seeing signs here that maybe there's a pause in the recent strong pace. So more data is needed to confirm that, but it is very telling early sign here. And if you look at the recent consumer confidence survey, so this is from the conference board, there's two lines on this chart. The first one, the blue one, is the present situation. As you can see, it's elevated, which is good, but it has not made any progress for multiple months, and now it's going sideways. And the gray line on the bottom is the expectations. It is by historical standard, let's say, middle of the road, and it has been deteriorating somewhat over the last few months. So is this starting to catch up with real data? Because the real data for consumption was pretty strong for a good while, but now are we starting to see a slowdown in the pace as consumer confidence is stalling? Maybe, as I said, it needs a few more months of data to make sure that there's a real trend here, but it is putting some sand in the gears, let's say, of the current thinking in the markets that growth is strong, led by consumers, inflation is falling, and all of that. So a few data points this week that made the markets doubt. When you look at the chart here for inflation forecasts, so what we did here is that we extrapolated the current pace of inflation based on a few scenarios. And when you look at the inflation over the last 6 months, the monthly pace of inflation was 0.3% on average for 6 months. If you look at the last 3 months, it's 0.4% month over month on average. So if you take those paces and you just continue to project those until this summer, until June 2024, what you see is that inflation, which has been going sideways around 3% for a good while, would be reaccelerating by the summer to between 3.6% and 4%. So that means that when markets, at the moment that markets are thinking the Fed should start cutting, we should be in an environment where inflation is higher, closer to 4% and accelerating, which is not, of course, conditions that would, make the Fed confident enough to start going, in our opinion. So there's ample risks on that. And interestingly, this morning, based on all of the data this week, markets have started to deprice the June rate cut by the Fed. Now they're thinking about July as more likely. So it's been pushing further back. And remember, at the beginning of the year, markets were pricing a first rate cut in March, and they were thinking 6 cuts for the year. Now it's more about July, 3 cuts during the year. So you see that the markets are depricing that and pushing the Fed further on. So risks for volatility in the markets as this is being depriced are increasing by the week here. Another inflationary risk here is the price of oil. So this week we had the International Energy Agency's oil market report for March 2024. On the left, you have a chart that shows that we should have a supply deficit in 2024. So supply should grow less than demand, pushing the market into a deficit. And there's 2 very interesting points made in the report on the right, that the trade dislocations from rerouting of Russian barrels mean that there's now more oil on water, so oil stuck in tankers around the world. It's 115 million barrels more. So that means that this oil is not in refineries being refined, transformed into gasoline. So there's a delay here in the supply chain, holding supply back. So this is an inflationary risk for sure. On the bottom, you see that there's a slowdown in growth, efficiency improvements, surging electric vehicle sales. This is also keeping demand back, but supply is held back by more than demand here, of course, with the extension of OPEC plus supply cuts. So we're not thinking that that oil is going to be exploding in 2024, but this is marginally pushing oil prices higher. So it could be another inflationary risk for 2024, linking to the story I just told you about inflation. Finally, gold has been a tactical position that we've had in our funds for a good while. There were many reasons that. The macro thesis was that the USD had peaked, real rates had peaked, also the technicals were getting pretty favorable for gold, so we put in a position there. Took a while for gold to react, but now in March, we've seen a good surge in the price of gold, close to 10%. And of course, geopolitics, what the deterioration of the situation between Russia and Ukraine, and in Europe, the political pressure that we're hearing there, especially from France these days, and also the financial uncertainty. You have lots of risk appetite for stocks, fueled by the AI story, big tech, but also you have lots of uncertainty now on interest rates, on what central banks are going to do. So this is all a very fertile environment for gold. So there was a lot of gain recently in the short term. We benefited from that in our portfolio. Now we're looking at how the trend will continue. When is it going to be time to exit that position? We'll keep you briefed on this for sure. So next week, what to watch: CPI, inflation, and retail sales in Canada. So I might be talking more of those same themes next week. And in the US, lots of housing, building permits, housing starts, existing home sales, and of course, the big data point of the week, the big event, will be the Fed decision Wednesday, 2 p.m. Everyone will have eyes on the dot plot, which is going to be in the summary of economic projections. It only takes two FOMC members to change their dots higher, so that we move from having a median of 3 cuts in 2024, move to a median of 2 cuts in 2024. So this is what everyone will be watching. So it's coming out next week, Wednesday, 2 p.m. So that wraps it up for the week. ia.ca/economy, iagam.ca/insights. Lots of material for all of your needs. Always a pleasure to serve you, and I'll see you again next week.